Well, without a doubt, there are many, many, many stocks acting better than tech stocks. I don't know that there's anything particularly profound about the fact that we have dispersion in this market. I could look at biotechs, for example, barely red. Those are supposed to be speculative stocks, but I think people understand they're down an average of 30 or 40% from their highs, and the science that they're pursuing is completely unaffected by the macro economy or the Fed. So, like, that's an area where if you're a growth manager and you say, okay, what's going to grow if the Fed slows the economy? Look toward mid-cap and large-cap biotech. That's reasonable to me. If you're worried about inflation, look at high dividend-paying oil companies that are about to report record profits. That's reasonable. Utilities look good. So I don't think we're saying anything special. Big picture, I come on here every week since January. I continue to give people what I think is the most reasonable playbook. You can't get too bearish because in the end, the best cure for the inflation blues is the growth you get from corporate earnings, dividends, and the U.S. stock market. But anytime you see that VIX tick below 20, which I think is the new bottom of the range for the regime that we're in since coronavirus started 2 years ago. And so we saw a 19 VIX on Monday. That was it. Start calming down. Start taking things off if you're a trader. Don't overstay your welcome. We had a nice run. Now the VIX is spiking once again. Back toward 28, 29, 30. Don't stay too bearish. There are buyable stocks at those VIX levels. That's when people get too bared up. And I agree with Tom. A lot of what's going on now is positioning. The only thing I want to say about positioning, and the only problem with that idea, is that it's not quite what it used to be. Meaning, yes, people might be getting risk off in the stock market, but keep in mind how much risk they're taking in private equity that they weren't taking years ago. It's like $5 trillion in PE funds. Look at venture capital. Crypto is $2 trillion. So there are a lot of risks that are being taken by institutions that are not stock market risk. So I don't know that we can still rely on how bullish or bearish positioning is based on the old metrics from a prior time. I'd love to hear what Tom's take is on that.
Well, let me ask you this first, because Jim's clearly speaking of defensive stocks, which have remained strong, as you said, utilities and the staples. And you make an interesting comment. I come on here since the beginning of the year and we talk about the playbook. And I wonder if yesterday's playbook works today, given what Brainerd had to say, what Dudley wrote. He basically said the Fed is not your friend. In fact, it's not even close to your friend. It's your adversary. And they want stocks to go down, and they're going to make stocks to go down.
That's wrong. That's wrong. That's wrong. I'll tell you why that's wrong. The Fed is your friend. They're doing this for a reason. It's not good for the economy and ultimately for earnings to let this run wild. The Fed is your friend. The nonsense has to stop. The nonsense. The trading of digital JPEGs amongst people who don't have a job. It's got to stop. 19% year-over-year increases in home prices. Did you read Barron's this weekend? They think 2 million people are going to be locked out of the housing market this year because of unreasonable costs. The Fed is your friend. The nonsense has to stop. We did an extra year of stimulus that was way unnecessary, and that's what's being unwound now, and it's going to be a better entry point for investors once we clear the decks.